all the major indices were down, and it has to do with an inflation number that we haven't seen for a very, very long time. So stick around. Hey guys, welcome back to TipRanks. I'm Richard Allen. Thank you so much for joining me for another video. The inflation number that came in today from the CPI data, the Consumer Price Index data, was 7.5% year over year. This is the highest number we've seen in 40 years. That's right, since 1982. About as old as my grandpa. You know, of course, I'm not anywhere close to that age. But we haven't seen inflation data in a very, very long time, as high as 7.5% year over year, and it was higher than Wall Street anticipated. Now, earlier on in the day, if you were paying attention to the markets at all, pre-market, it looked terrible. Everything was down, and then the stocks opened, at 8:30, 9:30 in the morning, and everything went up, including the major indices. It's like everybody was excited to buy the dip, and then boom, eventually throughout the day, things started to crash. The S&P 500 was down almost 2%, down 1.81% on the day. The Dow Jones down 1.47%, shedding over 500 points during normal trading. The NASDAQ was down over 2% on the day, shedding just over 350 points. So crazy, crazy day for the major indices. We're going to talk about the CPI data and the inflation number. We're going to talk about the 10-year Treasury as well, jumping over 2% for the first time in a while as well. So it was a crazy, crazy day out there in the market. But I believe there are some opportunities out there in various stocks across the board. But there could be a lot of pain ahead because people believe that the Fed is going to have to be more aggressive to curtail these inflation numbers that were higher than expected. And that is spooking the market a little bit. So these juicy, low valuation numbers we're getting right now on a lot of our favorite stocks, a lot of the small cap, mid caps, and even some of the tech stocks that are selling off right now, these juicy, juicy valuations and stock prices could get even a little better over the course of the next several months, depending on how the market pans out. So let's take a peek at the inflation numbers here real quick. We came in at 7.5%. That's a big increase, even after the scary numbers that were posted in December. If you take a peek at this chart here, consumer prices rise by the most in 40 years. But look at that chart. This is the big spike we're seeing over the past several months to the last year. Crazy, crazy spike there. Eventually, guys, and I want to say this because you're seeing a lot of fear out there in the market. You're seeing a lot of uncertainty. You're seeing a lot of doubt in the market. A lot of people refer to that as FUD, fear, uncertainty, and doubt. You're seeing a ton of different YouTube videos essentially with the sky is burning. If you're paying attention to the market at all, you're probably seeing a lot of thumbnails with fire and things like that, and the market's crashing, all that kind of jazz. It's only a matter of time before the market crashes. It's only a matter of time before the next recession or correction happens. We just don't know when it's going to happen. Now, I'm not saying that so that you're fearful in the market. I'm saying that because it's inevitable that we have corrections and crashes and recessions in our economy. It just happens. If you pay attention to the data, though, if you invest in an index fund over the course of decades, years and years and years and years and years, there's like a straight line up, right? If you actually pan it out over the course of decades and measure it out over that amount of time. Now, are there going to be ups and downs in that trend up? Yes, absolutely. We're going to see those corrections. We're going to see recessions. We just don't know when they're going to happen. Now, there hasn't always been a correlation between rising interest rates and stock market crashes. And you're going to see a lot of that right now as well. Is the Fed crashing the market? Interest rates are going to crash the market, that kind of thing. There's actually been an inverse relationship between higher interest rates and stock markets doing well. So it's not a guarantee that the market's going to crash, that we're going to get a correction. There are a lot of opportunities in the market that we've talked about recently on this channel. I wanted to tell you guys that in some sort of reassuring way, because it's you're getting a lot of fear out there in the market right now. And if you have decades still to invest, which a lot of us do, I don't think you have to panic. Unless you don't believe in the US economy long term, then maybe you can feel differently about decades and decades of investing in the stock market. But I believe that the US economy will do well over the course of the long term, and that's why most of my portfolio is long-term investments. All right, last thing I want to touch on before we finish this video is the 10-year Treasury yield. That is over 2% now for the first time since August 2019, so that's something to keep in mind as well. That's another thing that is spooking the market. But usually when inflation goes up, the 10-year Treasury follows as well. So that's what's going on. But again, there's not always a correlation between interest rates hikes, inflation, things like that, and the stock market performing poorly, okay? So pay attention to the data if you have time on your hands to really look at the data over the years, when there's a recession, how the stock market does. There isn't always a negative correlation between those things. So if that gives you any reassurance in investing in the market, let me know down in the comments. I would absolutely love to hear from you. Guys, be careful out there with your emotions right now, because it is going to be volatile probably for the next several months until we really figure out what kind of rate hikes we're going to get, because more and more people are paying attention to this. Even on the retail investment side, more and more people are paying attention to what the Fed is doing. It isn't just your hedge funds that are paying attention to this. It's the normal everyday retail investor as well that's paying more attention on the markets. I think that's a good thing, but it can really get to you psychologically and deal a big toll on your mental health if you're paying a ton of attention to this and you're not able to manage those emotions well, especially when you're investing your own hard-earned blood, sweat, and tears money into the markets, and you're watching it go up and down constantly because you have Robinhood or Webull or something on your phone that you're investing with. So guys, just be careful. Volatility, I think, will be all over the place, just like it has been. So thank you so much for joining me for another video. I hope this helped. If you learned something new or found any value in this video at all, let me know by hitting that like button and that subscribe button down below. And as always, I'll see you in the next one.